SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-Baffi Bocconi lecture on key insights from the IMF's April 2026 World Economic Outlook, Global Financial Stability Report, and Fiscal Monitor. The global economy is once again facing a negative supply shock as the international economic landscapes continues to evolve. What are the implications of recent geopolitical developments for the economic outlook on growth and inflation? What are the implications for public finances and the financial system? What are the potential risks for financial sustainability and financial stability? How should policymakers respond when vulnerabilities are already high and policy space is limited? The IMF's trio of flagship publications, the World Economic Outlook, the Global Financial Stability Report, and the Fiscal Monitor, shed light on these questions twice a year. And it is a great pleasure for me and for SUERF to welcome three distinguished IMF colleagues who will present these reports today. First, Deniz Igan, she's chief of the IMF Research Department's World Economic Studies. Deniz will highlight key findings of the latest World Economic Outlook. Then Stefan W, Assistant Director of the Monetary and Capital Markets Department of the IMF, will present the key findings from the Global Financial Stability Report. And third, Davide Furceri, Division Chief in the Fiscal Affairs Department, will explain to us key insights from the Spring 2026 IMF Fiscal Monitor. Fiscal policy under pressure, high debt, rising risks. We will devote about 30 minutes to each of the presentations, and then after each presentation, 10 minutes for a discussion. I will now hand over to Deniz to present the World Economic Outlook. Global economy in the shadow of war. What are the main takeaways of this edition?
Thanks everyone for joining. Good morning, good afternoon, wherever you might be. What is the main message coming out? What is the stage looking like for our World Economic Outlook that came out a couple of weeks back? It's basically we are seeing the global economy being tested again. So regional global geopolitical risks have been on the rise for a while, as you can see in the first chart in the slide. And this is across regions. If you just take the 1990s, that's the black line you're seeing there. That's the 1990s average of geopolitical risk index set to 100. And you can see that in 2000s, 2010s, and in particular in 2020s, we had a significant increase across the world, not only in one region. And what we are seeing, obviously, currently, what's happening in Ukraine, what's happening in the Middle East, are the latest culmination of these rising geopolitical tensions. Meanwhile, we had actually some possibly, good news on the trade policy side. Effective statutory tariff rate imposed by the US on its trading partners had actually declined. And this is in large part related to the Supreme Court decision of the use of the IEPPA for imposing tariff rates. But basically, compared to what we had assumed in our October report, we now have about 5 percentage point reduction in the tariff rates. And that's not to say that trade uncertainty has gone away. The US administration has signaled that it would be using other legal authorities to impose back the tariffs that were removed, and also bilateral agreements continue. What that means, the Supreme Court decision means for those agreements is also an open question. So overall, we have trade policy uncertainty still being high, along with the uncertainty that is related to the geopolitical tensions that I set the stage with. Now, before the start of the war in the Middle East in February, what things look like, how were we seeing the global economic outlook? And in two phrases, basically, we had continued resilience, at the same time rising fragilities. And where was the strength, the resilience was coming from? Especially in the largest economies, in China and in the US, the performance, GDP performance has been better than what we were anticipating in our October report and even in our January WEO update. And a big part of it is related to, continues to be related to the AI investment boom that is going on in the US. But there's a mirror image of that for Asian economies, in particular as the provider of semiconductors and other IT equipment. And you can see that in this picture where the technology exports are shown in blue and red bars. And it's not only US, that's the blue bar, but the rest of the world also have been importing a lot of these equipments from Asia. And even in China, where exports to the US has come down, we have been seeing both technology exports and other exports continue to be quite strong. And overall trade turned out to be more resilient, more adaptable than we had thought. The reorientation continues, as you can see in this graph showing the US imports from various regions, as well as China's exports to different destinations. So this kind of rewiring or decoupling between the US and China continues. And we have seen some reorientation of US imports to Mexico, but also in particular to Taiwan and Vietnam, so other Asian regions. Part of it, this is, as I shown in the previous slide, is related to what has been going on with the AI-related activity. And looking at the other side of the picture, Chinese exports to the US has now have been quite stable after falling since the end of September 2024. And we have seen some reorientation European Union, but this seems to be a bit, started before the tariff imposition by the US and also have been weakening a bit, but other Asia remains pretty strong. So this adaptability continued. And then we had the outbreak of the Middle East, and that's where the rising fragilities come into the picture. Geopolitical risk has increased a lot. That's the blue line you're seeing there. So we're pretty much at the levels that we had seen when Russia invaded Ukraine in 2022. Surprisingly enough, and then I'm sure Jason is going to talk more about that, markets have taken it a bit in a stride of what's happening in the Middle East. And you can see the red line, the weeks have been relatively contained. It has increased, but not at the levels we have seen during the pandemic or other geopolitical events. But things are changing by the day, of course. And meanwhile, what we have seen is the gold price increasing a lot, at least until recently. And that's as a hedge to geopolitical risk that we're talking about. So this kind of is setting the stage. Now, what does that all mean for the outlook? Basically, we are again in a place where we were last year as well. I'm sure loyal readers of our flagships will recognize what I'm going to talk about now. So a baseline requires a consistent set of assumptions that you can reasonably assume are going to remain relevant for some time. And in the current environment with very high uncertainty and the situation in the Middle East remaining very, very fluid and changing by the day, what's going to happen, all the uncertainty about how long the conflict is going to last, how severe it's going to be, And even after the conflict ends, how fast the recovery in the region on production facilities, on transportation is going to be. Those all make it very difficult to come up with such a baseline. So what we have done in our report is start with a reference forecast, and that is basically assuming a relatively short-lived conflict and gradual normalization of production and exports, energy exports from the region, resuming pretty soon. And the impact in turn on commodity prices, inflation expectations, financial conditions, the three main channels the conflict would transmit to economic activity are going to be limited. And based on these assumptions, we have the bottom-up projections by our country teams. Then we complement this reference forecast with two scenarios. In an adverse scenario, we have larger and more persistent increase in commodity prices. And in a severe scenario, we also have damage to energy infrastructure in the conflict region, which translates into even larger and even more persistent increase in commodity prices, with also some impact on quantities, energy imports from the region. Both our adverse scenario and severe scenario are top-down model-based projections at the global level. So for our reference forecast, just to give you a sense, because I did mention the limited impact on commodity prices, even though it's limited, it's not small. So in the first chart here, you're seeing in our reference scenario what we are assuming for commodity prices. And I will just get your attention to the blue line. That's the energy index that we have. And the dotted line shows you what we were assuming in October. And you can see a very sharp increase and only gradually coming down, energy prices gradually coming down in mid-2027, basically where they have started. And we also have an increase in food and metal prices also are retained. Monetary policy projections are as markets are broadly in line with markets are projecting. But again, comparing the dotted lines, the October assumptions to the current ones, basically we have an assumption of higher policy rates in the euro area and slightly higher also in Japan and somewhat lower in the US. On the fiscal policy side, we do have a gradual consolidation forward, but only in the later years of the forecast horizon. But in the medium term, especially in advanced economies, we have a more accommodative stance, and that is driven particularly by the US and in Germany. Now, based on these assumptions in our reference forecast, what we're coming up with is in 2026, we are projecting 3.1% growth in the world economy. And in 2027, we have 3.2%. Now, if it was not for the war, compared to January, where we had 3.3%, we would have been revising upward our global forecast to 3.4%. So instead of upgrading to 3.4%, we're downgrading to 3.1%. So it's the war's impact, in a sense, the 0.3 percentage point. And if it was not for it, the resilience, the momentum that I mentioned at the beginning would have set up the stage for an upward revision. And this slowdown compared to 2025 is pretty widespread, I would say. Maybe the US is a little bit of a outlier there. And the reason here is basically twofold. One is, as I mentioned, the fiscal support that is going to start kicking in later in the year, but also the net energy exporter status of the US somewhat shields it from the commodity price shock that we're assuming in our reference forecast compared to many of the other advanced economies. On the emerging market side, you can see that our revision from January 2026 is actually 0.3 percentage point. Again, this is a sharp slowdown. Part of it, this is related to the direct impact in the conflict region on economic activity. The hit is pretty large in several countries in the region, but also some Asian economies, some African economies, maybe not as much in Latin America. But overall, emerging market and developing economies are expected to be impacted much more negatively than advanced economies. And you can actually see that much more in this picture here, where when we group economies based on emerging markets, low income and developing and advanced economies, but also distinguish among their net energy importer-exporter status. In the first block here on the left-hand side, you're seeing the impact on net energy exporters. The middle block is the net energy importers, so exporters, importers, and then the MENA region, where you see we have a hit of 2 percentage points revision our reference forecast. But more broadly, you can see this pattern where the importers are being affected, energy importers are being affected more negatively than exporters. Turning a bit to global inflation, we do expect, so we have downward revisions to growth and upward revisions overall on inflation. There is variation across countries, and this variation is again coming from the fact that as we entered this new phase, we were already seeing services inflation being a bigger driver of inflation overall, and remaining persistent. But also, as you see on the second part of the graph on the right-hand side, variations in inflation explained by country-specific factors have also been increasing compared to what we had, the common drivers we had in the post-pandemic years. Now, as I mentioned, this is a reference forecast, but things are very uncertain, very fluid. So what does that mean for the global economy if things take a wrong turn and the impact from the conflict is larger, the conflict itself is longer and more damaging? Here we are comparing the global forecast for GDP growth and headline inflation under different scenarios. And you can see the blue line was our January, so that's kind of the benchmark, if you would, our January forecast. And the pre-conflict is what I was referring to. So if it was not for the war, if we made our forecast before the war started, we would be looking at the red bars, the slight upgrade in 2026 for growth, and inflation would have continued to kind of remain stable and then decrease in 2027, right? Our forecasts, our reference forecasts are in yellow bars, and you can see the downgrade there and the upward revision to inflation in both 26 and 27. And in adverse scenario, we have even more drop in GDP growth. These are the green bars, and more increase in inflation compared to our reference forecast, but coming back down, if you would, in 2027 because persistence is not as bad. But in the gray bars, this is our severe scenario. Then you see the hit to GDP growth is actually bringing it close to what you would imagine to be close to a global recession, so about 2% growth in 2026. And that has happened only 4 times since 1980. So that would be a remarkable outcome there. But also the hit to inflation being more persistent. So the gray bar in 2027 is actually just above 6%. And that would be the outcome under our severe scenario. Now, what are the downside risks? As usual, there are many factors that we think even under our severe scenario, we might be underestimating some of the geopolitical risks. So further intensification in the region, but also elsewhere in the world. we might have more disruptions, and this may also translate into domestic political tensions, and we may get hits from there. Something that we have been talking about for a while, and I'm sure Jason's going to also add on that, the re-evaluation of productivity gains coming from artificial intelligence and other technological advances. We have seen very rich evaluations, very high expectations of what that will mean for productivity. And if these expectations are disappointed, then we might have some correction that translates into the impact on investment and on consumption through wealth effects as well. And the borrowing costs themselves have been relatively contained, but fiscal vulnerabilities are on the rise. And this balance that we're seeing may be disrupted by an abrupt repricing of sovereign bonds and other equities, and they may create further implications for the real economy. And trade policies, we may again have flare-ups there and as an additional headwind. And erosion of confidence in economic institutions, trust in economic institutions remains something that we're watching closely. There is upside, and we might actually gains that are being backed on. Structural reforms may pick up in many countries, and we might actually have the opposite on the trade side, and maybe we will get more talks, more agreements, and more predictability on trade policies. Let me take you a little bit of the analysis that we have done on the first of these risks, given how prominent it has been. So we looked at the impact of geopolitical risk. This is just the risk itself. It's not necessarily conflict following just the tensions. And when we look at it, a 1 standard deviation increase on geopolitical risks can have a persistent impact on GDP growth by about 0.8 percentage point after about a year. On average. And just to give you a sense, I said 1 standard deviation, geopolitical risk increased by 1.2 standard deviation in Europe after the onset of the Ukraine war. And this is, of course, this impact is coming through consumption and investment, but also exchange rate depreciation, and in return, having some impact on inflation, maybe not as significant, but something that puts policymakers in a tough spot. And in our report, we also have quite a bit of, analytical work more on the economics of defense spending, as well as on war and reconstruction or recovery. And just to give you a flavor of those analytical chapters, what we find is that defense spending booms, which are becoming more common, which we're defining as sustained increases in defense spending by about 2 percentage point of GDP over 2-3 years. And what we see is that the impact on the economy, at least in the short run, is a boost to activity. It's like sector-specific fiscal stimulus, basically. And we do also see an increase in inflation. It's temporary, but a lot depends. But there is a trade-off here, and the trade-off actually comes more on the intertemporal sense. So this short-term boost to activity is often coming at the cost of more external sector vulnerabilities and more fiscal vulnerabilities as we go. Of course, that a lot depends on how the defense spending is financed. But again, trade-offs are not easy either way. If it's financed by more, raising more debt, then we have the fiscal vulnerability angle. If more of the spending is on equipment, military equipment that are imported in many of these countries, you have the external sector vulnerability coming on from there. But also, even if the defense spending is financed by reprioritizing the budget, often what we see is that this comes at the cost of social spending, and then that brings its own risks. Now, when conflicts do erupt, they do impose large persistent output losses. This is what I'm showing you here is, again, I said the chapter does much more than what I'm able to show you, but this is for the economies that are actually the sites of conflict themselves, and you can see it is a very, very large impact on GDP. And when we compare to other shocks, those are the dark blue bars in the middle, conflicts impose larger output costs than many other crises that we know, right? Banking crisis, currency crisis, sovereign debt, or even natural disasters. Conflicts can be more damaging than them. And there's a lot of heterogeneity, but just a lesson to keep in there. And equally worrisome is that when conflict ends, a lot depends on how durable peace is. And in our sample, which is a large set of economies since the Second World War, what we see is that in about half of the cases, within 5 years, conflict resumes. So peace is not durable. And what that means is that recovery, when it happens, is also very fragile. And a lot depends on reestablishing macroeconomic stability. A lot depends on international support for these economies. So there are other risks. I mentioned low-income economies at the beginning being hit particularly hard. Another risk for them, another challenge for them is that all this, higher food prices, higher energy prices, higher fertilizer prices are coming at a time where fiscal positions are very restrained, including because of the decline in official development assistance. Here you're seeing the international flows to low-income economies in sub-Saharan Africa in the red bars, and to other low-income economies in the blue bars. And net ODA, official development assistance, has been coming down. And we actually project in 26, 27, this is going to come down even more, putting a lot at risk in those economies. Let me finish with a more, brighter spot on the artificial intelligence and whether, productivity gains are possible and whatnot. One thing to consider there is that this is based on US firms. Adaptation is still not, fully complete. So if there is more adaptation in more industries, we might actually be in that good scenario where productivity gains from AI are being realized sooner than we might imagine, again, giving a boost to both short-term, but also hopefully longer-term growth. What to do in this very uncertain environment? The way we phrase the policy advice is countries need to address the current shock and they need to prepare for the next, because this is, second big shock in the last 5 years that is related to geopolitical risks only, let alone the other financial type of, turmoil that we have seen. So what does that mean? Starting with monetary policy, preserving price and financial stability remains crucial. What it means in concrete terms is that in the current environment, given all the uncertainty, treating this as what it is the textbook supply shock that may be short-lived, reserving the option to look through, waiting and see what actually transpires is the first response. But as things evolve, central banks need to communicate very clearly that wait and see is not inaction, and they need to signal very clearly that they are committed to price stability and they will be ready to act decisively and quickly if they see inflation expectations de-anchoring. And in order to do that, safeguarding central bank independence and credibility is going to be crucial. Exchange rates, we have our typical advice, traditional advice, using the IPF of maintaining flexible but orderly exchange rate adjustments, and prudential oversight, maintaining enough buffers is going to be paramount. On fiscal policy, there's going to be a lot of calls. We are already seeing some economies, some countries already enacting fiscal support. And there's going to be increasing calls if the increase in commodity prices and then the pass-through is here to stay. Our advice here is, again, sticking to the principles as much as possible. And what are those principles? Keeping any fiscal support, any discretionary fiscal support temporary, keeping it very well targeted, and also limiting distortion of price signals. So designing this support, well, not instead of blanket subsidies, or instead of price caps that distort the price signals and they do not curb demand at a time when supply is constrained. Instead of those, they need to go for more direct, maybe cash support to low-income households. And while doing that, if there's no fiscal room, this type of discretionary support needs to be financed by reprioritizing other spending. And if that's not possible, very clearly stating what's the credible path to restoring fiscal sustainability. And we have our usual, I'm not going to go in detail, we have our usual medium-term growth on structural reform agenda and making more predictable international economic rules environment as well. So let me stop here and look forward to the discussion. Thank you.
Thank you very much. Very comprehensive presentation. I wonder what you mean by smarter regulation. On your last slide, you argued that labor mobilization and smarter regulation might enhance growth. What kind of smart regulation do you have in mind?
Well, again, the details are much more explained in the report, but also in the country-specific context, in our regional economic outlooks and in our country reports. But what we mean is the reduction of inefficient regulations. And there are many examples in many country contexts, but also removing the impediments to innovation and competition in a carefully sequenced and well-targeted way. That's the way we see smart regulation.
I see. But it seems that in terms of inflation, you expect central banks to react much earlier this time than in 2020. I mean, there's still, in the main adverse scenario, there's still an increase of the level of inflation, but I think it's about 0.5% on the global level, which is relatively low to what we have seen 5 years ago. Why do you, is that a learning from the 2020 experience, or are there any different reasons for that?
Oh, well, just to be clear, what I showed in terms of the assumptions on monetary policy rates in major economies, those are not our recommendations. Those are our assumptions based on what the markets are thinking and what the policymakers are signaling. Our recommendation is not to act faster necessarily, but being more vigilant. And part of that is about lessons learned from the 2022 episode, obviously. And importantly, in our past reports, we documented that more clearly. Inflation expectations may be shiftier this time around because, in 2022, we were coming out of a very low inflation environment in many economies, and households had not experienced high inflation for generations. So inflation expectations remained anchored for longer than we would have imagine. This time around, we have, a generation and then still fresh memories of inflation rising very fast, remaining high. And equally importantly, I mean, and that's where the cross-country difference comes in, right? There are still economies out there where inflation has been stubbornly above central bank targets.
Yes, Austria,
right?
for example. Absolutely, yes.
So cases like that may require being vigilant. But just to be clear, we're not saying act now. We are saying watch carefully, signal that you're ready to act. But first, we need to see how this is going to play out, how persistent it's going to be.
Bergana, I cannot see any questions in the chat. Can you?
No.
Okay, wonderful. Then I can ask more questions here. I wonder what you think about the alternative measures to control inflation. A number of countries like Spain, for example, were quite successful with these measures in 21 and 22, and measures have been contemplated across Europe in terms of the reduced speed, maximum speed limits for cars, for example, to curb fuel consumption. Even a car-free day was proposed over here in Austria. It was the case in the 70s. What's the IMF thinking on such non-monetary policy measures to address inflation?
Yeah, we need to understand a bit better in a systematic way how effective they are. I mean, as I mentioned at the beginning, we have seen some economies, some countries already acting, some with fiscal measures, others are of the sort, with measures of the sort that you're mentioning. In Asia, for example, reducing the days factories are operating, or closing government offices a few days a week to reserve, to save energy. So we are seeing those. We don't have a systematic evaluation of them, how effective they are. In terms of curbing demand, they might be helpful, but of course they come at a cost, and how long they can remain in place is going to be a tricky one. But that, thank you for the question, because it opens up another advice that we have in this context, which is accelerating energy transition. This could be when I was talking about responding to the current shock, but also making sure that in the medium term we are better prepared, economies are better insulated from this type of shocks. And if there's one very good example of that, it is energy transition, right? Making sure that economies are even more energy efficient, systems are more energy efficient, and making sure that there's more green renewable energy, so that this type of oil-related, gas-related shocks are less have less of an impact on the economy. I think this is the window of opportunity that we can have this kind of more attention and more sense of urgency that would accelerate energy transition.
Okay, thank you. We have a question by Birgit Niesner, a former colleague of ours. Hi, Birgit. Her question is, what are the assumptions on military spending which boost growth? Is it consumption or investment-driven military spending?
Great question. I said, I put more of a teaser of that slide, but there's a lot of analysis in that chapter. And one of the key questions, we are finding on average, spending multiplier related to defense spending of about 1, but there's a lot of variation on that. And one of the factors is exactly as Birgit is alluding to, is it consumption or investment driven? So if you're hiring more military personnel, that is a short-term boost, but not necessarily in the long term, right? It doesn't carry over to medium term. It can create more overheating in the domestic economy. Whereas if it's more investment driven, it depends what investment we're talking about. as I mentioned, as now many economies are relying on imports when they increase military investment. We're talking equipments here, right? And planes, drones, what have you. There's a lot of leakage through imports, so it doesn't help as much on the domestic economy. It doesn't create that type of boost. But if we're talking more in terms of turning, existing factories to more military purposes, or building new facilities that would help produce military equipment domestically, then we have a different story there. And the last thing I would say there is that there is also we need to be very careful, right? We are finding some total factor productivity boost also coming from defense spending on average, but we need to be careful there because that is related to having the R&D component, not only investment in facilities, but having research and development that is for military purposes, but has private sector applications and can be fostered more between the fiscal spending, government spending, and private sector activities, and ideally also by academia that can create that type of environment where there's actually, we have the impact on TFP and medium-term growth boost.
Thank you very much. We move on to Jason now, and Jason will present the key findings from the Global Financial Stability Report. Thank you, Deniz.
Thank you. Good morning, good afternoon to everybody. I'm going to talk a little bit about the key findings from the Global Financial Stability Report that is published at the same time as the other two flagship reports. Just to give a bit of context, right? The war in the Middle East elicited a very strong initial market reaction. The peak level reached since the onset of the war of Brent crude, inflation expectations, and VIX are quite notable. So crude went up to 110 at some point per barrel, up $37 per barrel compared to pre-war. Inflation expectations, which we have discussed already a little bit, went up by, on average, 86 basis points across the G4 economies, that is Germany, Japan, UK, and the US. And the VIX went from 20 to 31, right? But I wanted to emphasize that these are peak impacts because what you saw is that during the first week of the war, the equity price changes have been very significant across jurisdictions. So the chart on the left here is a scatter plot. On the horizontal axis is the gains in the equity markets from the beginning of the year until February 27. And on the vertical axis is the change in equity prices in the first week of the war. So from February 28 to March 3rd. And you can see some very interesting patterns. The first is that, the higher the gains of the stock market so far this year, the bigger the drop during the first year of the war, right? So you can see this negative relationship between the horizontal and the vertical axis. And in particular, an economy like Korea saw its equity prices raised by 50% before the war broke out. And in the first week of the war, it gave back almost 20%, right? That's how to read this chart. And you can also see that energy exporters tend to do a little bit better, right? So Brazil and Nigeria is one of the only ones to have gained, right, in the first week of the war. Their stocks have done very well because, they are energy exporters. And in general, you can see the Asian economies have done worse because the terms of trade shock for them is perhaps the most severe. By contrast, if you move to the right chart has exactly the same x-axis. So it's the stock gains up until the war. Whereas the vertical axis, the y-axis, extends the impact study from February 28th to April 24th. So basically until the latest data. And you can see that the market has basically forgotten about the initial impact of the war, right? Much of it has been erased. Many economies, the stock prices actually turned positive again. Notably Japan, Korea, which saw huge drawdowns. Now they're back in the positive territory on net. And of course, a country like Nigeria, energy exporter, continue to rally. So that is all to say that the markets have since become quite sanguine as the war has dragged on. And one of the reasons why the market has been optimistic is because the futures market, at least in commodities, is indicating a modest rise in oil prices over the medium term that will normalize eventually. So I think Deniz spoke about this a little bit as well. This matches the left chart here showing the Brent crude futures prices matches, in my opinion, best with the reference scenario that Deniz has presented, right? So essentially, oil prices, very near-term shock, but through the course of the year, it's going to gradually come down and turn to a fairly modest level around 70 to 80 per barrel by next year. Another reason is because the market has been dominated by the ebb and flow of news from the US president. So I took the two graphs on the right from Bloomberg article. You can see that in the top, S&P's 5 best days during the second Trump term have all come against US government policy. That's the orange portions of the bar, right? Meaning that tweets, announcements by the president, etc., have driven all 5 such episodes of best days. And in the bottom chart, you can see the S&P 500's 5 worst days is also entirely driven by US government policy. Now, this contrasts other presidential periods you can see down the graph, where you have a mix of things, right? Including company earnings, economic data that also drives best and worst days. But it's all evident that during Trump 2.0, what is driving the market mostly is U.S. government alone. So this ebb and flow of news that drives both good and bad news, escalation and de-escalation in the context of the war in the Middle East, is leading to market being fairly optimistic overall. So this turns me to today's agenda about salient financial stability risks. We have to be cognizant that financial market tells one story, but the real world tells a very different story. Spot prices of commodities are significantly higher. During the spring meetings, I had the opportunity to speak to a few oil traders, and they are all very concerned that the physical market, meaning actual deliveries of oil, has been quite decoupled with the futures market, right? So spot prices of commodities are significantly higher. You have refined product shortages intensifying, for example, jet fuel, especially in regions like Asia and I think parts of Europe as well, like in the UK. You have shipping and logistics starting to be affected by the conflict. For example, the Suez Canal is seeing higher shipping costs and more traffic because Hormuz is closed. Food and manufacturing dependent on fertilizers, helium, and other products that could be affected by the Straits closure. And lastly, unlike tariffs, this war cannot be resolved by unilateral actions. There are multiple parties in this conflict, and it is not a matter of just reversing, like what we saw in April 2025, the tariffs that can undo the damage so far. So the bottom line is that the further supply shocks and more persistent inflationary pressures and higher inflation's expectations, higher interest rates and low growth, those are the confluence of things that can really shock financial markets. And when that happens, let me turn your attention to the bullets on the right. Salient financial stability risk could be triggered. I'll talk about 4 in the rest of my talk. The first one is bond market fragilities. Given that this is likely an inflationary shock, an interest rate shock, bond markets is the first place where we should focus on to see whether there are any fragilities in financial instability. There are emerging markets that are under pressure. That's the second point. The third point is all of this is happening amid high and concentrated asset valuations. A lot of times people refer this period, this war in the Middle East, and compare it to the 1970s, right? During which there was an oil crisis, very similar supply shocks. One key difference in financial markets is that asset valuations was not nearly as high, this high and concentrated as it is currently. So it remains a vulnerability that could lead to financial instability. And then finally, the fourth point, there are various amplification channels through financial vulnerabilities that I will discuss that could turn persistent inflation, higher interest rate shocks into financial instability. So the bottom line is that hopefully by the end of this talk, you'll be convinced that financial stability risks are pretty elevated. So let me discuss the first point, bond market fragilities. Since the outbreak of the war, monetary policy paths have been repriced upwards, but just a little bit. So on this chart here, you can see advanced economies on the left, where the dotted line is the post-conflict path and the dashed line is the pre-conflict path. And what you can see is that, essentially comparing pre and post-conflict, the path of monetary policy across all four of these advanced economies have increased. And most of it has been matched by rising inflation expectations in the next year or two. All right, so monetary policy is moving up, reacting to higher inflation expectations. The same can be seen in in emerging market economies on the right, where if you look at CEMEA, LATAM, and Asia, the path of monetary policies have all been repriced upwards because of the expected inflation. I wanted to emphasize that such repricing has been fairly modest so far, right? And the fear is that as the conflict continues and as actual inflation rises and pass through to inflation expectations, we might have to see these paths raise a lot more. And that is the sort of shock that could be financial stability relevant here. So speaking about bond markets, because this is an interest rate shock, bond markets are particularly fragile to these type of shocks. In particular, in light of the fact that the average maturity of newly issued debt has declined significantly across jurisdictions. So you can see the chart on the left here that, for example, in the United States, the average weighted maturity newly issued debt over the past 5 years has declined from about 3 years in the 5 years before to about 2, right, in the most recent 5 years. And every year, the maturity of debt has declined. Now, why is this a problem? This exposes government to rollover risks, right? If you are issuing very short term and interest rates are very low, then this is very economical to do so, right? You're paying less interest by going short. But the precise shock that can make this risky is when inflation is high, short-term interest rates were to rise, you are issuing a ton of short-term debt, and that will lead to higher interest servicing burden that will basically induce a lot of rollover risks in these economies that are already saddled with a lot of debt, maybe with the exception of Germany. But the other four countries listed here have all very high debt to GDP ratio, which Davide will talk more later. Moreover, we have seen that investors in sovereign bond markets have become much more sensitive because of the high debt. So the right chart here shows what happens on auction days for 30-year government bonds, right? So basically, it traces the impact of the 30-year yield on these auction days. And you can see that comparing the 3 periods of 15 to 19, 20 to 22, and then 23 to now, at least in 4 of these jurisdictions, the sensitivity of the 30-year yield on these auction days have increased significantly. So in the United States, for example, whereas in 2020 to 2022 period, the 30-year yield will elicit a 6 basis point increase in 30-year yield. Now it elicits like 12 basis point increase, right? So the market has become more sensitive to supply of sovereign bonds. And this means that this suggests to us that there is an absorption issue increasingly, as there's a lot more debt in these markets. Investors are requiring higher and higher yields in order to absorb them. So bond market, higher yields by itself is not a problem, but what we're concerned about is that, as we see more inflation and inflation expectation, there could be rapid repricing in bond markets that risks funding markets, and it could expose sovereign bank nexus. So the left chart here shows you in the US, the spread in funding markets, what we call the SOFR spread, that is basically the repo spread, the amount of rates charged in repo markets minus a measure of monetary policy spread. And you can see that spread spikes up periodically. Those spikes are quite modest, but what's interesting is that, market has also turned increasingly to use what we call the standing repo facility, or the SRF in the green line here, during the times when repo spreads increase. This means essentially that it is not that funding markets are inherently stable. It is because the Fed is there with the repo facility to catch the falling knife that has induced this funding market stability. So the fear is that if there's a rapid repricing in bond yields, funding markets will once again become unstable. And, I think the capacity of the repo facility remains to be seen, remains to be tested, right? Whether it can be effectively, limit the type of funding strains that we have seen during the global financial crisis and also during March 2020 at the outbreak of COVID. Another issue is when sovereign bond markets start to reprice higher, it could expose banking systems to so-called sovereign bank nexus. The idea that bond yields lead to losses on banks' balance sheet that hold these bonds. And because the sovereign is weaker, their capacity to help the failing banks is lower. So this creates a nexus between sovereign and banks. And this issue is particularly pertinent in emerging markets. And that's why the chart on the right here shows a hypothetical scenario of what happens to the capitalization, the CET1 ratio, right, of the banking systems when there are, impact of debt restructuring. So if sovereign markets were to fail, what happens to, essentially bank capitalization? And you can see that if we take the most extreme scenario, that there is a 40% haircut in sovereign bond markets, right? The most right cluster of bars. You can see that, the amount of capital in the banking system for some EMs, right, could fall below 5%, right? Basel minimum is 8% on average. And so it could, there are some banking systems that could become really undercapitalized if this sovereign bank nexus were to play out. So the bottom line is that, with sovereign bond markets now more indebted and investors more sensitive, we worry that there will be funding strains and there will be sovereign bank nexus, particularly in EMs, that could play out in very adverse ways. So this is a key financial stability risk. Let me move on to the second one, which is emerging markets. We have seen capital outflows being quite substantial since the outbreak of the war, even though asset prices of emerging markets have not tanked entirely. So the chart on the left here shows the cumulative non-resident portfolio flows into emerging markets since the outbreak of the war compared to other periods of geopolitical conflict. So you can see that, even, this chart it ends in the end of March. So we need to update this. But as of the end of March, about 1 month since the conflict broken out, you can see that the cumulative portfolio of outflows has already reached about 100 billion. This compares to about 40 billion during the Russia-Ukraine conflict. So portfolio outflows is much more significant this time, right? And the chart on the right here shows us that, in one of the first slides that I showed with the stock market across countries, that doesn't really cover some of the weaker emerging markets. If you do look at the weaker emerging markets, as in this picture, you can see that countries that are rated CCC or lower have seen their sovereign bond spreads rise by almost 400 basis points in some cases. And in particular, countries that have current account deficits, right? So on the vertical axis, you have current account as a percent of GDP, tend to be the ones that have seen the largest impact in sovereign spreads. So in other words, emerging markets have become more under pressure as the conflict has wages on through capital outflows. And for the weaker EMs, you have seen the sovereign spreads essentially rising significantly. The third risk I wanted to raise is high and concentrated asset valuations. Let me start with equity markets. So advanced economy equity markets have high valuations and high concentrations. The chart on the left here assesses valuations across the advanced economy stock markets. What we do here is that we have many permutations of models that tries to estimate the fair value of forward PE ratio, in particular the 12-month ahead forward PE ratios in these stock markets as a function of earning growth, equity risk premium, and the term premium, right? So the model implied fair value PE ratio is the red portion of the bar in the left here. So for example, in the USA, in the US stock market, the fair value PE ratio, forward PE ratio is about 20 times, okay? The pink version tells us the current amount of overvaluation. And so In the US, the amount of overvaluation is about 2 times. So basically, the market is around 23 times. The fair value is about 20 times. Actually, it's about 3 times in overvaluation. Importantly, you are seeing this overvaluation everywhere across these 8 stock markets that we have evaluated. So essentially, every stock market is overvalued. Now, the good news is that these overvaluations have not reached their historical max in most cases. Their historical max is represented by the dashed portions of the bar. So, for example, in Japan, the overvaluation reached about 26 times of PE ratios. Maybe, my guess is that in the late 80s. We're not quite there yet. But the takeaway from this chart is I wanted to convey that, all of these markets that we looked at have a current PE ratio that is higher than what is implied by the fair value of models. And not only is equity prices high, equity markets are historically concentrated, right? So in the right chart here, we calculate the HHI, the Herfindahl-Hirschman index of 6 stock markets, and you can see that most of them are in the red territory, meaning that compared to history, these stock markets are currently very concentrated in a few stocks. In the US, for example, the concentration measure is close to 98th historical percentile because the Magnificent Seven, the hyperscalers in AI are so dominant in the US stock market. And so stock valuations are high, they are dominated by a few names. This leads to concerns that, if there is a collapse in stock prices or valuations among these concentrated names, this could quickly percolate to the rest of the market. But it's not just an advanced economy story. We also look at an emerging market risk premiums heat map. So this basically looks at risk premiums in rates and FX markets. That's the first block. In sovereign and corporate credit markets, the second. And then finally, equities in the third. And you can see that, average across emerging markets, perhaps, the sovereign and corporate credit block has the lowest risk premium right now. In other words, high valuation. So not only is valuation high in, advanced economies, but in emerging market economies, you also see this valuation have sequentially increased over time to levels that are quite elevated. So the final financial stability risk that I want to mention is that, both bonds, fragilities, emerging markets coming under pressure, and, high valuations in asset markets could be amplified by various channels of financial vulnerabilities. So think of it as, the story being inflation become quite high because of this conflict, leading to high interest rates, increased interest rates hikes, leading to bond market fragilities, exposure of high asset valuations. And all of this can be amplified by the fact that, among financial institutions, vulnerabilities appear quite elevated, especially for non-bank financial intermediaries. So the left chart here summarizes, right, how non-banks have become super important in the financial system. Whether it is leverage ETFs or private credit, equity option markets, hedge fund borrowings, or the market cap of AI and infotech stocks, you can see that over the past 10 years, comparing 2015 to 2025, the sizes of these segments have increased significantly. So, for example, hedge fund borrowings have gone from about $2 trillion in 2015 to about $7 trillion currently. Lots of leverage has been undertaken in this sector. And interestingly, the banks have been very much providing, right, these kind of borrowings and financial leverage to many of the non-banks. So the chart on the right here shows, the share of cross-border bank funding of NBFIs by country. So, for example, if you look at the green line, right, United States, right now it sits around 50. What this means is that 50% of the global lending, cross-border lending from banks to NBFIs arrives at US NBFIs, right? So US NBFIs commands about 50% of this cross-border borrowing from banks. And nearly half of global bank NBFI exposures right, which is about 7% of global GDP, quite a lot, cross-border in nature. So not only has NBFI become more important, they have also increased in terms of their nexus with banks. Now, why am I telling you all of this? Because we think that these kind of NBFI exposures could be amplifiers of stress when the market has a downturn. So let me go through a couple of these, and then I'll pause. I'll stop there. The first one is in equity markets, we think that options and leverage ETFs are key amplifiers. So if you look at the chart on the left here, index option trading in U.S. equity markets have exceeded $4 trillion as of the latest data. And much of it is in the dark green, what we call zero day to expiry options. These are essentially driven a lot by retail investors, and they are very short-term options that can turn very quickly. The concern with option markets, of course, is that during good times, lots of people sell volatility. They write a lot of options. That leads to dealers, having a long gamma position. When dealers have a long gamma position, they operate in a counter-cyclical manner, which means that they are stabilizing. But when volatility becomes high, option sellers retreat from the markets, right? So for example, many of these zero day to expiry options will go away. This leaves dealers with a short gamma situation, and they start to act pro-cyclically, meaning that they will sell the underlying when the price is going down and buy the underlying when the price is going up, right? So this could exacerbate downward market action. Leverage ETFs is another example that could exacerbate equity market volatility. The gross leverage exposures of leverage ETFs remains quite modest, about 20 to 60 basis points, right, of overall market cap. But we have already seen that during the first week of the conflict in markets like Korea, the Korea stock market, leverage ETFs have played an outsized role in driving down equity prices because leverage ETF positions need to be unwound during times of volatility and when markets go down. So the growth of these two markets, the options and leverage ETF markets, is an amplifier for equity market volatility. Moving to another source of amplification is hedge funds. Hedge funds have expanded their roles in many asset classes, but the ones that we are particularly concerned about is the sovereign bond market, which I've mentioned before, as well as in EM markets. So hedge funds' positions in fixed income markets have risen significantly. You can see in the left chart here that the so-called arbitrage relative value trades in the US Treasury market, right, has increased significantly from about 1 trillion just a few years ago to around 2.5 trillion now. And these include the cash futures basis, swap spread trades, and other arbitrage trades. I'm not going into details here. There is online annex where we try to quantify the impact using value at risk frameworks of an unwinding of cash futures basis trade, for example, in the GFSR. And I think that the BIS and ECB have talked about these trades a lot as well. But I think it's worth noticing that, at a time when we're faced with an inflation shock, potential bond market fragilities, that hedge funds' relative value trade positions could exacerbate these fragilities. The second place where they have increased their presence is in EMs. And hedge funds tend to be flighty EM investors. So the left chart here shows the cross-border flows into EMs during the 2022 episodes of Fed tightening, which could be an analogy if the war continues and inflation rises to what we might see ahead, right? So in 2022, what you can see is that across the various types of EM investors, portfolio hedge investments by hedge funds is the most flighty one, the blue line here. The way to read this chart is that fourth quarter after the Fed started to tighten in 2022, hedge funds investment in EMs is 50% less compared to where they started before the tightening happens, right? So in 4 quarters, they withdrew half of their investments from EMs. So that clearly constitutes a very flighty situation for EMs. And, the capital flows chart that I showed before for the conflict in the Middle East this time, perhaps has to do with some of these investors as well.
Jason,
yeah.
Can you wind up, please? Because then we have questions in the chat and we want to ensure enough time for Davide as well.
Yep. So I have just a few more slides and I'll close up. So another amplification is the private credit market that has been in the news a lot. By our calculation, it is 4 trillion in total private credit exposure. I'm happy to address more maybe in Q&A, Stefan, on this. But I think the bottom line is that we see things a little bit differently from what the media has portrayed. When we look at default rates on the left here, as well as the liquidity gap for the semi-liquid investment vehicles, we don't see huge systemic risk at this point because credit quality has declined, but at a modest level, and many of these semi-liquid vehicles do have the liquidity resources to meet the redemptions. For example, the chart on the right here shows you that across these 5 BDCs, they can last about 9 quarters, right? Receiving 5% redemption requests every quarter before they exhaust their liquidity resources. Happy to go into this a little bit more in the interest of time. There is AI being an amplification story potentially as well, given the many circular investment deals that have been covered in the media. This chart here, basically, it represents 73 companies that we've looked at along the so-called AI stack, ranging from builders to energizers to hyperscalers to data center, right? What I want to draw your attention to is that, a lot of the revenue and debt along the stack has come from the so-called hyperscalers. And their overall vulnerability, you can see in the last column, we judge to be not super high. This is because they're profitable, they have liquid balance sheets, etc. Right? What about firms that are most involved in the circular financing? If we look at the subset of firms among the 73 that are most involved in circular financing, at the very bottom row here, you can see that the overall vulnerability score is about median, right? And not super vulnerable. And so we do think that this AI, sort of story, concentration, etc., could be an amplification mechanism to financial stress, but perhaps less concerning compared to bond market fragilities, compared to hedge fund leverage, and some of the other vulnerabilities. I'll just conclude with this chart, which basically tells us that we are also entering a very uncomfortable episode where stocks and bonds will sell off simultaneously. So focusing your attention to the very last set of box and whiskers, the post-2020, box and whiskers, you can see that during bear market episodes, the stock market in the red box declines by more, but also there is quite a bit of sell-off in bond markets as well in the blue box. So the box crossing zero means that there is quite a few periods where bonds and stocks have sold off at the same time. And so this means that it creates a concern among investors that there is nowhere to hide. You cannot go to stocks, you cannot go to bonds, and that exacerbates and amplifies financial stress. Let me conclude by giving a few policy discussions. Deniz have covered it very well, so I'm just going to focus on the first one. During times like this, it is important for authorities, particularly central banks, to make sure that liquidity and funding facilities are available and accessible in the event of acute market stress. There is a strong need for central banks to be attuned in terms of spillovers from actual inflation to inflation expectations, because a lot of the amplification and stress that I discussed could be unraveled by higher inflation and higher interest rates. I'm going to skip the fiscal point. Davide will go into it more. I think there was a question, Stefan, from you about smart regulations. Here, I mean, in the GFSR, we address financial regulations in particular. You can see that banks are now much more exposed to NBFIs, and even though the banking system is overall sound, we're quite concerned that globally agreed prudential banking standards is not going to be implemented now, right? There is a discussion about regulatory simplification and modernization, which is good, for that to happen, but it shouldn't compromise, right, the resilience of the banking sector. For example, capital and liquidity standards. So we feel quite strong about this. And given finally that most of the amplification could come from non-bank financial intermediaries, continue to strengthen the oversight of NBFIs is rather important. Sorry, it took me a little bit longer, but let me stop here. Hopefully we still have 45 minutes left.
Yeah, thank you. Well, in terms of the simplification debate, I think that we are really heading into a cycle of pronounced deregulation over the next couple of years. And that's going to be one of the major risks. not covered in this report. We have a question from Alice Bell that very much links to your last slide. Taking into consideration all the risk analysis you presented across markets, what safe assets do you come out with this war episode, and how do they differ from your pre-war analysis if you have learned something during this war? So what's the safe asset now?
Yeah, thank you. I have to say that you know, the issue with equities and bonds selling off at the same time, we have pointed that out before in previous GFSRs. It is particularly sensitive to supply shocks and inflationary shocks, and so there is a sense that, you know, longer term government bonds is becoming less and less of a safe asset, right? And a lot has to do with sort of like investors also being uncomfortable with the level of debt, you know, that's incurred around the world. I'm sure Davide will talk about this. So, you know, we didn't have a very strong view on what would be a safe asset before the war broke out. But what's obvious, you know, with hindsight now is that cash remains king, right? If you look at various investor surveys, if you look at how markets are positioned, lots have been put into, you know, US dollar front end, for example, euro front end, you know, and there are smaller safe assets like the Nordic currencies, you know, perhaps gold, some people will say, but those markets are relatively small. So I don't have a very good answer to this question other than cash. But this is precisely the point, right? That when there is no place to go for investors, you know, the market reaction could be a lot more adverse.
Anything to say about the housing market and commercial real estate? When short-term rates go up and the bond market rates, the safe asset swap goes up as well, do you see any significant risk to global housing and CRE markets?
Yeah, that's a very good question. I think in 2 GFSRs ago, we did a comprehensive assessment of debt servicing ratios of households, which is important in answering this question. So I think there are 2 dimensions. There's the debt servicing ratio, and then there's how much of the household debt, namely mortgages, are floating rate in nature, right? So I think we get a mixed set of responses when we look across countries. In Europe, for example, there are a number of economies that are more exposed to floating rate mortgage markets. However, those are also ones where the households seem quite comfortable from a debt servicing perspective. So I would say that overall households are starting from a fairly solid footing. It all depends on how big the interest rate shock would be. You know, even in markets where debt service ratio is currently healthy, a 300 basis point increase in interest rates would do a lot of harm, right? So it's really depends on the size of the shock. And I think we can take this away as homework to repeat that exercise next time to see, you know, where global households are.
Thank you very much, Jason. Well, Davide, what does the fiscal monitor tell us?
Thanks, Stefan. Let me share the presentation. So good morning or good afternoon, everybody. Really happy to present the latest fiscal monitor that has been recently released. What is really driving the fiscal monitor are the outlook are both cyclical and structural element that I will try to cover. Of course, the main cyclical element has been up to 2025, has been the very high level of uncertainty that we've seen in the policy domain, not only about tariff, but there's been also quite uncertainty regarding the fiscal policies in many countries. What we've seen is this uncertainty has recently abated in the first few months of the year, but is as Deniz mentioned, is starting to pick up again due to the war and the geopolitical risk. Indeed, like this geopolitical risk is affecting countries and their fiscal position in very several ways. The first, of course, is like the channels that Deniz has discussed through the impact on output and inflations. But often what we see is that countries, they tend to respond, they have a fiscal policy response to the increase in energy prices or increase in food prices. Some of these responses in some countries, mostly emerging market low-income countries, is sort of automatic, in the sense that many countries, for example, have subsidies in place that basically they transmit the shock in terms of food price to the fiscal balance directly. In others, they have responded more discretion. And indeed, this is what the right chart is showing, so that typically, like, the fiscal response has been very heterogeneous, both, of course, between importer and exporter, but also if you look within energy import, you see that typically low-income countries and emerging markets are typically those countries that are more affected by the increase in energy prices. Typically for energy exporters, the fiscal effect usually has been quite positive. This year, for some fiscal exporters, and particularly those in the Middle East area, the effect for some of them is still negative, because what you see is you have an increase in price, which is, of course, a good omen for the fiscal balance, but also what we've seen a significant cut in production and export in some of the oil exporting countries. So in these cases, also the fiscal revenue have been declining. So this is basically what is really shaping the outlook in the short term. But as I mentioned, there are also more structural challenges. Deniz discussed about growth. Let me talk about what we see in terms of the two key variables for the fiscal outlook. So on the one hand, the overall balance, and the other, the debt. You see that the overall balance is expected to be pretty much the same as last year, but it's going to be more deteriorated than what we were projecting in April 2025. And for that, of course, you see like the opposite pattern. You see that the debt is expected to increase by more than 8 percentage points in the next 5 years. And actually, to breach the magical threshold of 100% in 2029, reaching 100.2 in 2031. And just to give you a sense of how large this number, this is the highest level of global debt that we have seen since the Second World War. Another element that makes the fiscal outlook quite challenging, and it is an element that you'll see that there is often recording in this presentation, is high interest payment. And this is something that is different from previous periods of debt build-up. What we have seen is many periods of build-up, including, like, for example, like the global financial crisis or COVID. Those periods are typically characterized by sort of stable interest payment or interest rate. Now we see in situations where rates are much higher and interest payments are much higher. So they are expected to reach 3.3% of GDP by the end of the projection horizon. And as I'll show you later, for some of these, for some countries, these interest payments are really, really high. In some countries, they actually reach almost 40% of the country's total revenue. The primary balance is expected again to deteriorate. Again, the deterioration is not only cyclical, so what we've seen from the impact of the crisis, but it's really structural. And basically, there is less and less actions for many countries in terms of their willingness to do basically fiscal austerities to stabilize or even to reduce that. Okay, so interest rate, as I mentioned, have been high, and have been high not only in what we've seen historically, so emerging market low-income countries where this interest payment has increased, but they've been high and increasing in key advanced economies. If you look at the long-term, this has been basically increasing since 2021, 2022. They are further inch up after the war in the Middle East. And this is also an interesting pattern. You see that this increase in yields not only has happened for advanced economies or emerging market, but also for key systemic economies such as the US, Germany, or Japan, for which we see these countries as sort of safe haven in terms of their debt profile. If you look at the trend spread does increase for most of the 2000 up to 2025, suggesting that indeed higher interest rate, higher on bonds, they were not just the byproduct of tighter monetary policies, higher inflation, or the positive outlook, but also really like an increase in the risk premium. And again, this has happened not only for average, not systemic economies, but also systemic economies that have typically had very low risk premiums, just like the US and Japan. During after the war, what we see is like that this term spread has declined in some of these economies, and this is mostly in terms of expectation of tighter monetary policies due to the inflationary shock that the war is creating. But overall, what we've seen, I show you like that is going to reach 1 and 2% of GDP, but the outlook is really very much heterogeneous. It's heterogeneous across income groups, so it's very heterogeneous if you look at advanced economies versus emerging low-income countries, and each of these groups has a very different challenge. But also within each country group, so if you look at advanced economies, emerging low-income countries, there are significant heterogeneity. Which we're going to discuss. So first of all, what is clear is that what is really driving up the global debt are the two major economies, namely the US and China. Both of them account for a significant proportion of global GDP, and in both economies, what you've seen a deficit to increase and stay sustained over the medium term for the next 5 years. And this is what is really driving this change in public debt. What you've seen on the left-hand chart, you see that the main difference, one important element that is making the debt profile to look much worse than we had before, are two factors. One is, as I mentioned before, primary deficit. So countries are doing less in terms of addressing fiscal pressures and putting their fiscal house in order. And second is the snowball effect that is coming from the interest rate. This interest rate is really affecting importantly the dynamics in many countries. And one thing that is important to stress is that while for many years we have many countries that benefit from a very positive differential in terms of R minus G, so the difference between interest rate and growth. Now R minus G on net term is contributing to increase the dynamics. In terms of country, as I mentioned, US and China are the major drivers of the increasing global outlook. There are, however, some systemic economies for which we have seen that that is declining notably, and this is Japan. And mostly, as I'll show you later, because of the higher inflation in Japan compared to what we've seen for many years, which basically improved the debt to GDP ratio, because basically the numerator effect, it has to, at least in the short term, tend to be larger than the numerator effect in terms of debt. And you see that the debt to GDP ratio in Japan is projected to decline markedly. Okay, so one other element that sort of worry us, and it's not only the high level of debt, but also both the composition of the debt in terms of maturity and who is holding debt. And these are something that also Jason has mentioned. So in terms of the global evolution, what we've seen is that who is holding debt has changed, and the change towards more private debt holder. And this is basically has happened as a part of the normalization in bond purchase by many central banks, so as a part of the QT, if you want to call it. You see that central banks hold less than public debt than before, either directly or indirectly, and the private investor has increased their share. Now, it's clear that this change in the composition in who is holding the debt is going to affect interest payment, because private market are typically much more sensitive in the price that they would like to offer to purchase the debt based on the riskiness of the debt profile or actually the stock of debt. And what we've seen indeed is that the sensitivity all long-term yields to public debt has typically increased over time. And there is a research paper that we have done recently in our fiscal affairs department that actually shows that, for example, if you look at the sensitivity or US interest rate to debt in the interest rate, this is sensitivity has basically doubled in the last 6 years, 7 years. Another element that is worth to note is that if you look within the private sectors, what you see is two sources of potential vulnerability. The first has been discussed a lot by Jason, and basically are non-banks. And Jason as well went to in detail discuss what are the potential spillover, the potential cost if financial stress arise in the situation of banks, and what does this imply even for that, and vice versa. Another element that we've seen in many emerging market and low-income countries is that domestic banks have holding much more debt than before. In other words, because of the interest rate globally have increased, many low-income countries now they don't issue bonds externally, they issue more bonds domestically, and this is implying two things. On the one hand, yes, it makes the exposure of the debt profile of many countries less risky and less vulnerable to external shocks, but also create a sort of negative spillover domestically, where basically, as we have seen in some countries, public credit has been higher than private credit in many situations. Another element, if you look at the debt profile, and this is something that is quite salient for the US, is the maturity of the debt. If you look at the maturity of the debt in the US, as really becoming more and more short term, this is, at least in the US, something that is mostly done for debt management. And indeed, what you see in the case of the US is that when interest rates rise, so interest payment rise, the debt profile tends to be more short-term maturity than longer-term. But as I will show you later, this is this pattern has also implication, for example, for the conduct of monetary policies. As I will show you later, when the economies, when the profile of debt is much more short-term, what happens is that the transmission of monetary policies to the domestic economies is going to be amplified, as well as the transmission of monetary policy to the dynamics, because it's going to change. Basically, the interest payment almost directly is going to be much more relevant. And as I will discuss later, these two factors are also element of potential spillover across the world. Now, we discussed that many of these elements have been, of course, like many countries are now facing the shocks investigating through various channels. But what we emphasize in the report is that the fiscal outlook is not only weaker for secular reason, but importantly for structural reason. Indeed, it was funny when we were almost writing the fiscal monitor, we were mostly focused on the structural element, but it seems that every time that we come with the conjunctural chapter in April, there is like some major shock hitting all economies, and we get to refocus or reprioritize, or as Deniz show you, present a very alternative scenario. And what you've seen is, if you compare like the reference scenario in our projection, if you compare the reference scenario for 2024 to 2029 versus the, let's say, 5 years ago, so we can think about these two periods as sort of periods without very large shock. At least this is what we had in mind this time around. You see that fiscal position are structurally bigger, and they're structurally bigger not only for the weight, let's say, because of the US and China, so the main driver of public debt, but they are typically worse for the typical economies that we cover. And this is what we are going to show you, like in this chart. So we have 3 lines. We compare, so 3 charts. For each chart, we compare 2 lines. We compare the 2014-2019 average and the average between 2029-2024. And we are going to single out both the weighted variable, which is affecting the computation of our global GDP, but also like the median, the fiscal value for the median economies. And what you see is that the primary balance is worsened for both the median, of course, the weighted. You see that interest payment is where like most of the deterioration is coming from. And of course, the debt as a result. You see that the entire debt distributions are steeply shift to the right, and the difference are salient, almost 6 percentage points for GDP for the median economy. And of course, for the weighted, this difference is much more, because what you see is the US and China are driving the outlook. So for the weighted figure is about 15 or 16 percentage point worse than what we had back in time in 2014-19, which is quite large. What is driving this deterioration are different country profile, what we discuss, and are of course many factors that affect the two countries. And particularly there are two. One has been much weaker revenue and the government spending, as well as the interest payment. Growth on average in contrast has been a sort of a positive element to what we've seen in terms of this worsening. Now, another element that is interesting is that to give a sense of how structurally bigger we are now compared to the past is if you look at what we call the global fiscal gap. So the global fiscal gap is the difference between the primary balance of a countries and the primary balance that would have to stabilize debt in the medium term. And when we entered in 2014-19, this fiscal gap was positive. So there was a sort of margin that will help buffer the 12 countries to eventually to stabilize debt. And now it's basically to zero. So it means that for many countries, actually, the public debt is not even stabilizing, not even at higher level, but it's not even stabilizing. And that's what we've seen before. Okay, let me go to the outlook of a few specific economies and then the risk. As I mentioned, the outlook has been driven mostly by two key economies, the US and China. In the US, there are a few elements that are worth to note. Of course, on the revenue side, the main difference from what we had in the past are revenue that are coming from custom, almost 1% of GDP in 2025. If you look at the budget deficit, the budget deficit following the one big beautiful bill has seen like two elements. One is projected that the deficit to stay quite large, about 0.75% of GDP increase for each year. And this is really, bringing up the debt to the US to more than 140% of GDP. And the second element is that, at least you can see directly in this chart, some of these measures have digressed. For example, low-income transfers has been cut, while general transfer, for example, have been increased. And the third element that we'll discuss a bit whether we discuss China is that the fiscal stance in the US right now is quite pro-cyclical. It's a positive outlook gap, and while there's still a positive outlook gap, we have a significant deterioration in the fiscal balance, something that we have not seen in the past before. Typically, we have seen, especially in the case of the US, that to increase, of course, during periods of crisis, as a part also the policy response, then the economy is improving, and once the economy is improving, the fiscal deficit used to decline. This is not something that we are currently projected right now, according to our group projection, please. If you see China, China is having also large significant fiscal deficit. Some are of the measures that they put in place, for example, like the issue redemption of the debt at the local level, fiscal support. But what is different, at least in the short term from the US, is that the level of procyclicality in the case of the US has been much higher. In China right now, the output gap, for example, for 2025 is projected to be negative, and you are like a very expansionary fiscal stance. But as well for the US, there are not yet, at least in place, any specific measures that will help to bring down the debt in the medium term, and the debt is projected to increase quite markedly in the next 5 years. If you go to Europe, you see, and other emerging market, you see like two defining element. Japan, as I mentioned before, is within advanced economies where debt actually is projected to decline and to decline markedly because of inflation. If you look at Europe, the pattern is quite heterogeneous, but what you've seen is definitely spending pressure increasing. 16 countries have advocated the national escape clause to increase for defense spending, at least in the short term. But the main challenge is that when the escape clause terminates, additional fiscal resource should be funded to compensate this additional defense spending, which is spending categories that is pretty rigid. In other words, so this is what is shown on the right charts. The autocorrelation of the spending is 0.8, means that it's a component of spending that when you increase is very hard to bring it down in the short term. And of course, this creates challenge in the way that the countries will have to adhere to the fiscal rule once the escape clause is deactivated. Emerging markets have been characterized by favorable financing conditions on average, at least until now. Now you see like much more differentiation than before. What we're seeing is issue of sovereign bonds has been placed at a very good grade for many emerging market economies, and there has been a significant compression in bond spreads. If you compare 2022 versus 2025, you see that the compression has been more than 200 for almost 250 basis points. Where the outlook is probably more challenging is in low-income countries. And this is despite a significant gain in revenue mobilization. If you look, for example, in many low-income countries, the ability of these countries to generate revenue has quite increased in the next 3 years, in the past 3 years. But this important improvement has been sort of offset almost one-to-one by the increase in interest payment. And as I mentioned before, the increase in interest payment as a total revenue for the low-income countries aggregate is projected to reach almost 15%. But in some countries, this ratio is even much larger. Countries like Kenya is almost to project to reach 40%. And this is problematic because, as we shown like the fiscal monitor, when interest payment typically increase, implies that there are less resources for other things, and the way that the countries typically react is on the one hand, yes, they try to increase revenue, to tighten the balance, but then also to cut spending. And what typically is cut are spending either in education or health or in investment. So this is what implies is when you have an increase interest payment, basically spending for development tends to decline. Another interesting and specific feature that is affected by low-income countries is the reduction in official development assistance flows. We have done a survey internally to see where this cut is likely to be larger in many countries. And what you see is that on average, we do expect ODA flows to decline by 0.3 percentage point of GDP, so from 1.8 to less than 1.5. And most of this cut actually is concentrated in sub-Saharan Africa. And what you see, like in some of these countries, the reduction in ODA flow can reach up to 4% of GDP. So we are talking about significant resources for these countries. And again, when these flows are cut, what you typically see again is spending on development, so spending on health, spending on education, that these countries are forced to cut. Let me go quickly to the risk. Risk are both linked to cyclical factor and structural. Our measure of debt risk suggests that in a severe scenario, global debt could reach almost 117 percentage point of GDP. And what we show is that for example, the measure of debt risk could increase by almost 4 percentage point in the severe scenario that Deniz has presented, where most of this increase will be for emerging market because they are more vulnerable. If you consider like a scenario, as again also discussed by Deniz as a potential risk, what is going to happen to debt and debt risk if there is a repricing about the profitability of AI, you see that this can further deteriorate the debt outlook quite markedly, and especially this deterioration in this case will be for advanced economies where most of this investment in AI has occurred so far. There are, however, also important structural challenge and structural risk. We have seen there are two that are quite salient. One was for advanced economies. The main risk is age-related spending pressures. which sometimes are not fully incorporated in our projections. But also, even when they are fully incorporated in the projections, they are typically incorporated based on demographic projection. But what we've seen constantly in recent years is that there has been also significant revision in forecast regarding population growth. So the population dynamics has been worse than expected. This is likely to translate in worse than expected spending on pensions. If you look at the low-income countries, the main challenge is not necessarily aging. Actually, many of these countries, population growth will be a key driver of growth and will be an important element also for fiscal revenue going forward. In many emerging market low-income countries, the main challenge are contingent liability stemming from state-owned enterprise that in few cases have really led to significant deterioration in public debt, as shown in the charts, like up to 7% of GDP. And another significant element for fiscal cost in many of these countries has been natural disaster, which for the median low-income countries, for example, natural disaster typically brought about 7% of GDP increase in public debt. And the third, for low-income countries, the main challenge, as I mentioned, is ODA. ODA cut are very incorporated already in the baseline, but further declines could significantly hamper expenditure on health and social benefits, which will be significantly bad for the development prospect of many of these low-income countries.
Davide, you have 2 more minutes.
Yeah, so now just wrapping up with the policy conclusion. And then we're going to open for a question. So the main policy implications, so let me reiterate what Deniz has said about the various policies. Here we're focused on fiscal. So many countries, they have of course, the need to face these new energy shocks. And what we learned also from the 2022 crisis is that the best way to respond is through targeted support. What we saw in the past is that typically broad-based support has been A, quite costly, B, has been difficult to unwind. So many countries, they typically took time to unwind some of the broad measures. And third, some of these broad measures are quite regressive in the sense that they tend to benefit more the richer household rather than poorer one. And therefore, like because of this consideration, targeted support that is temporary with a clear sunset clause and addressed to vulnerable household or viable firm is a priority right now. Of course, this is a key question is how this fiscal support should be financed. Now, in countries where there is ample fiscal space, there is scope for fiscal policies to be not only basically to be countercyclical. For countries where there is a limited fiscal space, their additional resources have to be identified to finance the target support through either spending restraint or increase revenue mobilization. So this is the main challenge for the short term. The main challenge for the medium term is really addressing significant spending needs that many countries has. And this is implies a very well-designed plan to reduce high debt. And this is, in many countries, this implies a reform on the pension front or wage rationalization or subsidy reform, in the case, for example, of some emerging countries. In others, this implies revenue mobilization or improvement in compliance. And this can be done importantly not only by either cutting spending or increasing taxes, but this improvement in the balance can be done, as for example, we've shown in the previous fiscal monitor, by spending smarter, by addressing inefficiency in the way public money is spent, but also can be done on the tax side through revenue mobilization. For example, for many low-income countries, what we've seen is the technical assistance effort and critical assistance support through, for example, digitalization in revenue or to improving just instruments to improve tax compliance has led in many countries to significant fiscal revenue. So key priority right now, let's face the supply shocks in a way that is consistent with the stability of fiscal position. And let's have a very strong look at the medium term to make sure that public debt is set to decline again. I stop here and I'm happy to take questions.
Thank you, Davide. A very comprehensive tour across the world and the major economies. My takeaway is that the risks for banks have increased substantially from sovereign debt. We face an increase of 8 percentage points to 102% of GDP, high interest payments for the sovereigns, higher risk premium, QT. Banks hold more of these domestic bonds. You said that banking sector contingent liabilities are a severe risk to the fiscal position in 39% of the countries in advanced economies and in 47% of emerging markets. On top of that, we have demographics, defense, green transition, and extreme weather. So is this the time to rethink the zero risk weight on sovereign debt?
Well, it's really the time to put the fiscal house in order. As you mentioned, like these risks are quite significant. So already like the baseline projection suggests a significant deterioration in the fiscal outlook. And you mentioned like some of these risks. And unfortunately, what we've seen, for example, for past research at the fund is that sometimes past of these risks materialize and tend to materialize more than what we expect. The typical forecast error in that projection is quite large. It's about 10 percentage point of GDP. And this is because, yes, some of these risks often tend to materialize. But also, I think one important point is that there is often a sort of, countries announce policies to bring that down, but ultimately what we've seen is that it's been very politically challenged for many countries to bring that down. So actions have not followed announcement in many cases. And that's why, like we also, in the chapter, what we are emphasizing, we are doing a lot of work, I think, at the IMF on this, on the political economy of reform, or more broadly on the political economies of reducing fiscal risk, or fiscal consolidations, in the way that, there are challenges. These challenges involve trade-off, and it's important to communicate and try to engage with the civil societies, with the sticky stakeholders to advance all these policies that can be politically difficult at some point.
I think that quantitative easing also contributed to fiscal problems in this set of countries like Germany and Austria, where the costs of QE were underestimated significantly and now amount to about 10 billion only in Austria, and of course, an order of magnitude higher in Germany. Well, we have a question in the audience from Ismail Sayreg. What do you think about the hegemonic place of the US dollar among the reserve currencies with respect to the possible effects of the current war in the Middle East, possible effects of it on US assets in general?
So, well, on the dollar, what we've seen is actually, and Deniz can comment more if she wishes, that the dollar has appreciated during the current war, and this is sort of seen again as what we've seen in past episodes when there is a global risk off, the dollars tend to appreciate. So the journey of the dollars in this respect has been there. What has been different at this time is, I'm trying to find the slide, is what is happening to bond yield in the US. During period risk off episode, what we see actually that bond yields in the US have declined. Now they are increasing, and probably part of now they are increasing is because of the factor that we mentioned, different composition of holder, different maturity and so forth. But you see that since basically March, yields have moved up, especially at the longer horizon, if you look at 30 years. And one thing that we identify in the chapter is that when US interest rate increase because of worsening fiscal position, you typically have a significant spillover, and this is, for example, the spillover that you get from an increase of treasury of 100%. Oh, sorry, in this case is 1 basis point. You see that the spillover to interest rate in other countries is almost 1-to-1. But also not only you have financial effect by transmitting a higher interest rate, but also you have a real effect because because of the tightening financial conditions in other countries, as well as because of lower US demand. And you see that this type of shocks, they generate the weaker industrial production elsewhere.
Mm-hmm. Well, thank you very much, Davide. I see no further questions in the chat. So I would like to thank Deniz, Jason, and Davide for excellent presentations of a lot of material, fascinating reports, and I've learned a lot. And I hope that next time you publish these reports, we will have an opportunity to hold another SUERF event. I would like to thank all participants for their participation, and SUERF is looking forward to seeing you at the next event very soon. Have a nice evening or day. Bye-bye.
Bye.
Thank you.
Thank you.
Thank you.
Bye.
Bye-bye.